In today's video, we're going to discuss some techniques to help us avoid getting crushed by our own strong biases. So if you're like most human beings and have suffered losses due to a bias or some overconfidence, stick around. We've taken 2 hours of our proprietary training for our prop desk in New York City and made a free workshop. I spent 30 minutes going through our stock selection process where we find the best risk-reward stocks each day. We go through 3 high-reward, low-risk setups that are used by traders on our desk. Check it out. Click on the link above. Sign up. It's free. It's great. We've had tons of positive feedback. Okay, for today's video topic, we are talking about making sure that our trading bias does not cause us to take unnecessarily large losses. So I'm going to give you a few things that you can do to avoid this problem. Now, right off the bat, the first thing that we ask traders on our desk to do, and those who go through our training, is to develop a trading plan. If we have a plan that we're going to trade against, it's unlikely that we're going to do reckless things with our bias. We're just not going to plow in on the long side if we have a long bias. We're not going to plow in on the short side if we have a short bias. Or at least most times, that'll act as a safeguard having that written game plan. And so what I love to see from young traders is when they post their trading plan for others to see, whether it be in our chat, whether it be on Twitter, or even just the fact of writing it down itself where they can hold themselves accountable. So that's guardrail number 1. Here's a few other rules to keep in mind. Price confirmation at key levels. If you have a long bias, you want to see it hold key support levels. Rule number 2, it's okay to get back in. This is going to really help you avoid unnecessarily large losses when you have a bias. You come in, you have a long bias, you get long, you have your support level, it drops the support level, you get out. A lot of people, they don't feel like they can get back in. Yes, you can. That goes back to the original point from the top of the video, which is have a detailed trading plan, and part of your detailed trading plan should be, if you initially get stopped out, how are you going to get back in? Rule number 3, identify buyers and sellers on the tape. Let's say it's coming down to an area, you're long the stock, you have a long bias, and you notice there's a large buyer in there, they're buying tens of thousands of shares. Use that buyer to help you as a confirmation to get bigger in the position, and if that buyer continues to step up, you stick with your long position. If that buyer disappears, lighten up or get flat, and vice versa on the short side as well. And also I might point out to you, let's say you have a short bias and something is trending higher, and it finally stops going up, and then it comes off a little bit, and then you notice a large seller come in. Use that large seller on the tape to help you size up a position and stick with that seller until you see them disappear from the tape as well. Rule number 4, be aware of time of day. Stocks tend to move up and down in the first 15-20 minutes. We call this price discovery. They don't trend. Generally, trends start after 10 o'clock. Large reversals start after 10 o'clock. On the open, things will generally move up and down between well-identified support and resistance levels. So those are a bunch of ways that you can help yourself avoid taking unnecessarily large losses with a bias. Now let's take a look at an example. Here's the morning game plan that we used on March 6th. I actually had a pretty strong bias. The reason why I decided to do this video was I had a pretty strong bias on the short side in NIO NEO. I thought that for a variety of reasons, it was a particularly good short setup. And you can see on the sheet, I put in there 850 to 860 was the area that I was initially looking to get short. Above that, I thought also 890 to 9 was potential resistance. But my feeling was that this was such a good negative catalyst that I really wanted to be aggressive. And I kind of checked myself. I really did think over the next couple of days that it would get down to our S3. You can see on the sheet there, I always put the support and resistance levels, and S3 was 7.25. So my thought was, if I can be short this thing around 860, and I'm risking no more than 15, 20 cents, and I can capture a move over the next couple of days down to 725, about $1.30 of downside with 15 to 20 cents of risk, that's better, much better than a 5-to-1, and it's a very liquid stock, and that was my feeling. And well, let's take a look. So here's a chart on NIO. So the reason, one of the top reasons why I had a short bias on it was coming into the numbers about a week ago or a week and a half ago, it actually had some positive catalysts, and going into earnings, a lot of people were long it from above $9 a share. Anybody who's been watching my videos for a while, one of the top things I look at when something comes out with a catalyst is how are people positioned coming into that catalyst. People were really long this. This stock, from a bigger picture perspective, if we take a look at the daily chart, you can see had bottomed in late December at $6, and then people accumulated it in January at $6.50. Then the buyers stepped up in February to $7. So everybody's long this stock over the last few months because it's trending higher, trending higher. Then right before the earnings come out, it had shot to the upside, and people were long it from above $9. You can see the week coming into this catalyst, most people, just eyeballing this chart, the 30-minute chart we're looking at right now, people are probably long this from above $9.50. And the stock comes out with a catalyst, and what happens? Comes off hard, very hard from $10 down to $9. And that's the after hours. And then when we come in the next morning, you can see that it's already down below $9, and it's actually moving towards $8. And so people are trapped. It's already come off quite a bit. Now again, when the announcement's made, it's at $10, sells off hard in the after hours to about 8.5, moves back in the after hours back up to 9. We come in the pre-market, it's down in the low 8s. So I did allow for the fact that maybe my short area 850 to 860 would actually get above there. And perhaps could get to 9, but I did not want to miss this. And so if we take those things that I gave you in terms of the rules that I gave, let's zoom in and take a look at the 1-minute chart and kind of think about how this went when the market opened. So market opens, it holds $8 right on the open, goes straight up to my short price, 850 to 860. I'm able to get short basically pretty much at 60 cents, 58, 59 cents. Immediately trades right back down to 8.25. Now notice when it comes into 8.25, that's where it was having trouble getting above in the pre-market, and it supports there. And so I'm thinking to myself, okay, I'm going to take some off, cover some risk. I got a quick 30-cent down move. It's not getting below 8.25. Maybe I'll be able to short it back up between 50 and 60 cents again. And if it fails there and it starts to trend, I'm going to be in a position of strength. And if it closes below 8, I'll catch that move the next day, which ended up being today, to 7.25. So what happens? Catches a bid. It gets back up there, fails above 50 cents. See the big red bar that I highlighted to you? That's when I thought, wow, I've really got this now. People bought it right back up to above 850. Hard down move there to below 40 into the 30s. I'm just going to stay short this as long as it's below 850. And if it gets above the opening print high, I'll cover a little bit. And then if it gets above 870, I'll cover the rest. And I'm really, again, I'm keeping my risk small. My downside, I'm thinking, is at least down to $8, maybe a little bit below 8. And if it closes below 8, my S3 is 7.25. Maybe I'll get that the next day. So let's go to the next chart. So what you can see on the next chart is the buyers actually start to step up, and it starts to hold above 8.5. And then it's kind of consolidating at 860, and it's not looking good. And so I don't want to be stubborn on this. Basically, my levels are 850 to 860. You saw it on the morning game plan sheet. And so if it gets above there, above 60, I'm going to cover most of it. And if it gets above 70, I'm going to get stopped out. And then I'll start again if it comes down and starts to hold below 860 again. And you can see basically I get stopped out of most of it when it spikes above 70 cents. But when it comes back down hard below 60, I can get back in. And at this point, I know the high of the day is just above 870. My risk at that point is still only 15 cents. And then my next confirmation will be if it gets below the half, 850. And then I'll just stay short it the rest of the day as long as it's trending lower. And so you can see right on the open, spikes to my short price, comes off hard, lower, looks good, but eventually Very slowly they step up. I get stopped out of most of it, but I get back in, and coming into today, the stock's below $8, eventually hit my 7.25 target, and it worked. And so I didn't force the issue, and I understood that I might be wrong, even though I had a strong short bias on it. And if it started to hold above 870, I could reload even at a better price at $9 and have even more upside all the way back down to 7.25. And so I wasn't stubborn about it. It eventually ends up working. But in the back of my mind, I had those rules. The number 2 rule was okay to get back in. Price confirmation at key levels. I did not get price confirmation. Initially it sold off hard for me. That was quick price confirmation, but by 9:45 it was back above 860, and it wasn't until 10 o'clock where it started to hold below 850. Identify buyers and sellers on the tape. I didn't use that particular one, but if I had watching closely below 850 and I saw a large seller below 850, I'm going to use that as well. And then also at time, be aware of the time. As I said at the top, after 10 o'clock, it did peter out basically above 870 and then started to reverse. And that's when sometimes we catch our reversals and our trends after 10 a.m. So basic lesson is we don't want to get married to our biases. We don't want to get overconfident. There's always going to be a chance to get back in. And eventually my patience paid off. It trended down, closed at the low, and went all the way down to our S3 on day 2. Hope you learned something here. Hopefully you can employ this in your own trading.